Understanding the profit and loss statement P and L. The profit and loss statement P and L, also known as the income statement, is one of the key financial statements used to assess a business's performance. It shows the company's revenues, costs, and expenses during a specific period, typically a quarter or year. The P&L is essential for tracking profitability and monitoring how effectively a business is converting revenues into profits. 1. Components of a profit and loss statement. The main components of a P&L statement include revenue sales. This is the total income generated by the sale of goods or services. It is typically the first line in the statement and reflects the business's top-line performance. Gross revenue, total sales before any deductions, including returns and allowances. Net revenue, revenue after returns, discounts, and allowances. Cost of goods sold, COGS. These are the direct costs associated with producing or purchasing the goods that were sold. The COGS includes raw materials, direct labor, and manufacturing costs. Formula for gross profit. Gross profit equals revenue minus COGS operating expenses. OPEX. These are the day-to-day costs of running the business, including salaries, rent, utilities, and marketing. OPEX excludes the direct costs of producing goods, COGS. Operating profit, EBIT. This represents the profit the company makes from its core business activities, excluding non-operating income and expenses, e.g., taxes and interest. Formula for operating profit. Operating profit equals gross profit minus operating expenses. Non-operating income and expenses. These include any income or costs not directly related to the company's main business operations, such as interest income, investment gains or losses, and interest expenses on debt. Net profit. This is the final profit after all expenses, taxes, and interest have been subtracted from revenue. It is also referred to as the bottom line. Formula for net profit. Net profit equals operating profit minus interest expenses minus taxes. Text, taxes. 1.2. The importance of the P&L statement. Profitability measurement. The P&L statement is used to measure how effectively a business generates profit from its revenue. Cost management. By tracking costs and expenses, businesses can identify areas for cost reduction or efficiency improvements. Investment decisions. Investors use the P&L statement to assess the financial health of a company and determine if it's a worthwhile investment. Tax reporting. The net profit figure is used to calculate tax obligations. Managing profit margins. Profit margin is an important profitability indicator that shows how much of a company's revenue is turning into profit. There are several types of profit margins to focus on, each offering insights into different aspects of business performance. 1. Gross profit margin. The gross profit margin measures the percentage of revenue that exceeds the COGS, reflecting how efficiently a company produces or acquires goods. Formula for gross profit margin. Gross profit margin equals gross profit divided by revenue times 100 profit. Text revenue, you write, times 100 importance. A higher gross profit margin means the company is effectively managing its direct cost of production or purchasing. 2. Operating profit margin. The operating profit margin looks at the percentage of revenue remaining after covering operating expenses. It provides insights into the company's operational efficiency. Formula for operating profit margin. Operating profit margin equals open parenthesis, operating profit over revenue, close parenthesis, times 100 or times 100. Importance. A higher operating profit margin means the company is managing its overheads well, such as rent, utilities, and salaries. 3. Net profit margin. The net profit margin is the most comprehensive measure of profitability as it accounts for all expenses, including taxes and interest, and represents the final profit after all costs have been accounted for. Formula for net profit margin. Net profit margin equals net profit divided by revenue times 100 to right, times 100. Importance. A higher net profit margin indicates that the company is more effective at turning revenue into actual profit, which can lead to a stronger financial position. Key strategies for improving profitability. Managing costs, optimizing pricing strategies, and increasing efficiency are key ways to improve profitability. Here are some of the most effective strategies. 1. Cost reduction. Reducing costs without compromising product quality or customer satisfaction is one of the most effective ways to improve profitability. Strategies for cost reduction. Negotiate with suppliers for lower prices or better terms. Streamline operations to reduce waste and inefficiency. Outsource non-core functions, e.g., IT support, payroll, to reduce overhead. Implement technology to automate routine tasks and reduce labor costs. 3.2 Pricing strategies. Adjusting pricing can have a direct impact on profitability. However, it is important to balance competitive pricing with maintaining a healthy profit margin. Strategies for pricing. Dynamic pricing. Adjusting prices based on demand and supply conditions. Price differentiation. Charging different prices for different customer segments based on perceived value. Bundling. Offering products or services in bundles at a discounted rate. 3. Increasing revenue. While controlling costs is crucial, increasing revenue is equally important for boosting profitability. Strategies for increasing revenue. Expanding product or service offerings to meet new customer needs. Improving customer retention through loyalty programs or better customer service. Diversifying revenue streams by exploring new markets, customer segments, or geographies. Increasing sales volume through targeted marketing campaigns and promotions. 4. Operational efficiency. Improving operational efficiency can lead to cost savings and higher profit margins. Strategies for improving efficiency, lean management, reducing waste, and optimizing resource utilization in business processes. Inventory management. Minimizing inventory costs by ensuring just-in-time inventory or implementing drop shipping models. Process automation. Utilizing software or technology to automate routine tasks and reduce human error. Analyzing profitability and adjusting the budget. Once you have a P&L statement in place, it's important to regularly review it to ensure that the business remains on track to meet its financial goals. 1. Regular review of profit margins. By monitoring profit margins regularly, a business can assess whether it is maintaining healthy profit levels or if adjustments are needed. Look for deteriorating gross margins, which could signal rising production costs. Widening operating margins, which may suggest that overheads are being well controlled. Net profit margins that are too low, indicating potential inefficiencies or underperformance in pricing strategies. 2. Adjusting for seasonal variations. Businesses with seasonal fluctuations should account for them when analyzing profitability. During high seasons, profits may surge, but careful planning is needed to ensure profitability during slower periods. Plan for fluctuations by building a financial cushion during high revenue periods. Adjust pricing strategies or promotions to align with customer demand. 3. Cost and revenue alignment. Review the P&L statement regularly to ensure that cost-cutting measures are aligned with revenue growth strategies. For instance, increasing sales without managing costs effectively can erode profit margins. Conclusion and summary. In Module 5, we have examined the core concepts of profit and loss, P&L management, from understanding the structure of a P&L statement to identifying and improving profitability through effective cost management, pricing strategies, and revenue growth initiatives. Regular analysis of the P&L is crucial for making informed decisions and ensuring the business remains financially healthy. As businesses grow, managing P&L effectively becomes even more important. The next module will explore advanced budgeting techniques and tools that can help automate and refine the budgeting process.